Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 1st April 2022. And joining Derek to pose some questions on the financial market themes for the week ahead is Michael Owen, MUFG's Head of Global Client Desk for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Derek.
Afternoon, Michael.
We have no FX Weekly publication this week, given it's the first of the month. And I know you've been working on the latest FX Outlook, our monthly with global FX rates and forecasts. Are there any changes to the forecast or updated views going forward you'd like to tell our listeners?
Obviously, I would certainly say we're in one of those periods where forecasting a couple of weeks, let alone the coming 4 quarters, is extremely difficult, and there are obviously a number of big uncertainties, certainly closer to home in Europe here in relation to the Russia invasion of Ukraine. In terms of our forecasts, those listeners who are familiar with our current forecasts, we had been arguing the case for dollar strength in the first quarter and possibly into the second quarter, and then the dollar weakening beyond that. And we haven't really changed that. If anything, we've become a bit more convinced that the scope for dollar strength has become more diminished, and the view then is that with the yields in the United States at levels that they are at, the catalyst for further notable dollar strength from here seems a lot less. Now, the DXY did advance in March during the initial period of the invasion. The dollar did advance by 1.7%, so it was a fairly notable dollar gain. But a big chunk of that, nearly half of that, was just dollar yen. And the euro drop was certainly more modest than the markets expected, and indeed what we expected. And that I think has kind of made us have a not a rethink, but just kind of ask the question: Are we close to the bottom in euro dollar? And I think there is a case to be made for that. Now, I think very short term, we've had a strong payrolls report today. Short term yields up 10, 11 basis points. The euro's under downward pressure, and I think we can certainly break 110 and have a look back below 110 again. But as I said a moment ago, a lot is now priced in the United States. 50 basis points nearly priced for May, 85 basis points, 87 basis points, probably even a bit more now priced for the next 2 meetings. So it's going to take a lot for the rates to be compelled further higher from here. And in that sense, I think the rate story is becoming less convincing for arguing for continued dollar strength from here. And I think on the flip side, the inflation prints that we've had in Europe this week, it does make it more and more difficult for the ECB to continue to argue caution and imply that the demand side of kind of focusing on inflation risks, that takes more precedence. I think we're getting to the point where the ECB is going to have to acknowledge the risks to inflation, and therefore I think there's a chance over the coming months that the ECB gets a little bit more hawkish. Now, admittedly, that didn't happen today. We had Chief Economist Philip Lane talking about potentially pulling back on the speed of removing stimulus if the outlook deteriorated. So I accept that's a risk perhaps to the view, but I certainly think with inflation up at these levels, monetary tightening is is coming. And again, that's priced in Europe, but for the ECB to be moving back towards zero, I think is a big story for Europe, given how long we've been in negative rates. And I think that can have some additional support for the euro. I think it's also worth mentioning that Christine Lagarde this week spoke about approximately 200 billion worth of spare capacity in the EU Recovery Fund, essentially funds that haven't been taken by countries who decided not to take up the offer of cheap bilateral loans. They took the grants, of course, but not the loans. And that kind of capacity within the EU Recovery Fund could be utilised to support Eurozone households through this energy crisis. And of course, that additional fiscal stimulus support, I think, would also help to limit the downside for euro. Then, of course, we've got the TLTROs started to mature later in the year. I think in that sense, the outlook is still for the euro to advance and to reach 116, 118 by the end of this year. Now, there's the obvious risks to that. We do assume kind of a form of de-escalation in the conflict. There's indications that the focus is going to be more on the eastern region of Donbass, and if it becomes more regional in that sense, that's a form of de-escalation. We also assume no disruption to natural gas prices, and I think that's very important because the correlation between natural gas prices in Europe and euro dollar has been quite high of late, and we do assume no disruptions there. So fully accept there are some big risks in relation to our view that the euro can move higher later in the year. But for now, we're sticking with that forecast profile. Other than that, sterling we've nudged lower a little bit. The scale of hit in terms of real incomes, as listeners may have already seen in terms of the estimate from the Office of Budget Responsibility, is real disposable incomes will drop by 2.2% in the fiscal year beginning today. And that's the largest disposable real income drop on record going back to 1956. Incredibly, the UK government are raising taxes just as we have this huge energy inflation shock. And that's unique relative to most other countries right now at the moment. And I think that means some, economic performance divergence that is going to weigh on the pound. So we've adjusted our pound forecasts a bit lower on the back of that. Those are some of the key changes.
Yeah, thanks very much, Derek. And moving on to the short term, what is on the horizon that might have an impact that our viewers would find, our listeners rather, would find of interest?
Going into next week, obviously, Russia-Ukraine is going to remain front and focus. I've just mentioned there in terms of our forecasts for euro, the assumption of no disruption to natural gas supply from Russia into Europe. And, that will always be watched very closely from an FX perspective because it has an immediate potential impact on the macroeconomic situation. Now, we have had this announcement, of course, this week of the decree signed by President Putin for payments to be made in Russian ruble. The setup of that facility is going to be through Gazprom Bank, the one bank that hasn't been sanctioned by Europe and the US. And essentially, it will involve an energy buyer setting up a foreign currency account and a Russian ruble account. Crucially for the markets, and why there hasn't really been that much impact from this, is that the contracts haven't changed in terms of quantity, in terms of payment, in terms of currency to make the payment, crucially. And it's still in euros or US dollars for most contracts. And that will remain the place. That will remain the case. And it's only Gazprom then that will conduct the transaction in terms of switching the euro amount in the contract for the payment into Russian rubles. So really, this decree is more for domestic consumption. It's more political than anything. And from an energy buyer's perspective, I don't think it has huge implications. Now, the uncertainty later on could be in terms of contracts and the pressure for contracts to be renegotiated in Russian ruble. I can't see energy buyers doing that, but you could argue that there is a degree of uncertainty going down the road in terms of that, and that creating some issues. But of course, it just kind of reinforces the need or the want of people to move away from buying Russian energy. But I think certainly near term, I wouldn't expect any implications from that. Also, then next weekend we've got the French presidential elections. Maybe some listeners have forgotten. It certainly hasn't been on the radar very much. Nothing like in 2017 when it was a big issue for the markets. Interestingly, it looks very likely we will have a repeat of the second round between Emmanuel Macron and Marine Le Pen. Polling at the moment, 28% for Macron, about 21% for Le Pen. And it's a done deal, close enough, I think, that those will be the two in the second round. And the interesting thing is that Le Pen has shifted a little bit away from the far right. And that's making her suffer a little bit in first round polling, because you've got Eric Zemmour on the far right who's kind of taken over some of her mantle. And that's kind of lost her some votes. And then there's the hard left, and all these other candidates who are in the first round, and her softening of her hard right policies has lost her some polling. But where she will probably take advantage and benefit from that is in the second round. And in 2017, Le Pen lost with 34% of the vote versus 66% for Macron. The polling for the second round on the 24th of April is Macron on 52.5% and Le Pen on 47.5%. So a much, much tighter race in terms of second round polling. And if Le Pen was to do better than expected in the first round on Sunday the 10th, that could certainly create some nervousness in the markets in the run into the second vote on the 24th of April. So something to watch next week if Le Pen, and the momentum has been a little bit with Le Pen. She has been closing the gap on Macron. So if that momentum continues next week, the markets will probably start to take note a little bit more. Certainly if Le Pen does well in the first round, better than expected, you may see some political risk premium being priced into the markets ahead of the second round vote on the 24th of April. So yeah, that's it really. We've had the jobs report in the US today. Another good report, and as I said, front end yields are up quite notably in the US. So we're still on the cards, we think, for a 50 basis point rate hike on the 4th of May from the FOMC.
And finally, your trade ideas. What are your updated views for the coming weeks? Usually we kind of update in the FX Weekly, and as you mentioned, Michael, that there's no FX Weekly this week, being the first of the month. So we will take a look at that again next week. Currently, we still have open a short euro-dollar position. So, as I mentioned a moment ago, very short term, I wouldn't be surprised if we see levels back below 110. But I think we're reaching limits, so I'm not sure we'll run that position for too much longer. Other than that, dollar yen is making headroads back higher again after the correction. I certainly think short term, the yield story in the US remains compelling into the meeting on the 4th of May, when they will probably hike by 50 basis points. We also see crude oil prices moving higher. So despite President Biden's announcement of a release of 180 million barrels, a million per day over a 6-month period, we're still in a very tight market. And in that sense, there's still going to be upward pressure on prices through the month of April, we think, and certainly over the second quarter. So that combination, I think, is still quite compelling for dollar yen to move higher. Whether we can break above the 125 high that we've hit, that's certainly more debatable. The rhetoric from Japan is becoming louder in terms of disorderly FX movements not being desirable. So the political aspect ahead of the July upper house elections could mean that those voices get louder the higher dollar yen gets. So
you bring in more two-way flows as dollar yen moves higher. So you would probably struggle to get much above the 125 level. So the upside is becoming more limited, but certainly the fundamental backdrop to why dollar yen has got up to these levels is unlikely to change over the short term.
Thanks very much, Derek, and wishing everyone a good week ahead.
Thanks, Michael.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.